Hello, this is Jim Riggio. This is part 2 of the Monday Market Muse for February 7th, 2017. What we're going to talk about today was the effect of how leveraged and inverse ETFs actually work. So I wanted to end up picking, one that I think a lot of people have probably traded. It's the most popular in terms of volume out there, and that's the financial services ETFs. Many of you will end up knowing XLF is the base ETF, and then we have the triples, right? The triple leveraged FAS, and you can end up seeing over here, this is the triple bull, and then the FAZ. Okay, and so what I wanted to do is, let's start with XLF. Okay, those are the three symbols we're going to be looking at. And I'm going to end up comparing how this is done. Because in this bullish run, you can end up seeing from 2011 up, this thing should really end up being great to have the bullish, the triple bull. Excuse me. So the way I'm going to end up doing this, I'm going to end up coming to my graphs here, and let me end up putting in a comparison. And we're going to end up comparing this to the FAS, right? The FAS was the triple bull. You can see that right there. I'm selecting it, hitting OK. Now here's the really amazing thing. The triple bull over this period of time, when we've obviously clearly had a bullish move after the 2008, and you can end up seeing where we were. And we were pretty close here. If you take a look at where we've run up from, you can see in bullish runs, there's definitely a difference. Now, here's one of the challenges. You need to compare these and choose a starting point. So right now, I have the starting point going back 20 years. So let's take a look and saying, well, that's probably not the greatest thing in the world. So let's take a look at what a 10-year chart would end up being, because they were both in existence for this time frame. Now, when I come over and I take a look, oh, it's still not there. I'm going to have to end up going out to 5 years. This will end up giving us a better viewpoint of how this is run up. Okay, so I'm looking at this, and our starting point is 5 years ago. And you can see here that I have the price of the XLF on the right-hand side and the price of the triple leveraged FAS on the left-hand side. And you can see the graphs, and they're relative in terms of percentage. And even with this huge run up, the triple has not done anywhere close to what you would end up expecting. And even if we take shorter time frames, okay, let's take a look. Let's try to take a look instead of a 5-year chart. Let's see what's happened over the last 4 years. Right, similar starting points. Let's see if we end up making it the last 3 years. Daily. Still, relative. Okay. How about even just the last year? Okay. What's going on? How come my triple isn't giving me triple the performance during this bullish run? How many folks know how that math ends up working? Here, what I want to end up doing is, let me take out an Excel spreadsheet just as kind of as a worksheet here to kind of end up showing you what ends up happening. Okay. If we have, let's say, a index, right, and we're going to end up, I'll put in the same letters that we've ended up using here. So let's put in XLF, okay, and this ends up meaning, right, I'm going to just call it single long. And then over here, I'm going to end up putting in the FAZ. And again, we can use anyone here. And this one's going to be the triple long. And let's end up going and calling it XYZ. and saying that we had a 5 times leveraged. Okay, and I just want to do this for the example. Okay, because understanding how this actually ends up working, I think it is pretty critical for you to end up saying, hey, this is the one that I want to end up using. Okay, and so let's say, and we'll just put in some prices. Let's say if we go from, and over here what we'll do is have the price. Okay, so over here I'm just going to end up keeping the price, and we're going to end up changing the price. Let's say if the price goes from, right, 10 to 11 back to 10. Okay, and then on in 3 days, right? So I'll just say price over here. I didn't want to create this beforehand. I thought about doing this, but I wanted you to actually think about this with me as we end up creating it, because I want you to be able to think through this stuff yourself. Okay, and so here are the 3 days in a row. This is what ends up happening, right? Not super leveraged. So let's go and take a look and see what the percentage change was. Okay, so over here I need to end up taking a look at, because everything's going to go by a percentage change. Okay? And we're going to have to end up doing this for each of the others. And we're just going to end up multiplying it. So on the triple over here, what I'm going to end up doing is to make life a little bit easier. This way we can end up multiplying. And this happens when you build your spreadsheets, right? This is going to be 3 because I'm going to multiply this by 3. This is going to be 5. Let's go through this 2-day example. So on the first day, we know if we go from 10 to 11, we go up 10%. Let's actually put in, well, what's the formula? What the formula is you do the following, right? We're going to equal today's price divided by yesterday's price minus 1. Okay, and these numbers are going to end up being the same, and they're going to be percentages. Now, here's what I wanted you to end up seeing on this thing. A lot of people initially think, oh, I went up 10%, and let's highlight this so that we keep an eye, right? Because this is the one that's going to drive everything. People say, oh, I went up 10%, I went down 10%. No, you didn't. You went up 10% because 1 divided by 10 is 10%. But when you went down to 10, now it's 1 divided by 11. So you only went down 9.09%. Let's do this triple leverage thing again. And to make this different, let me make each of these 100. Now, what ends up happening here is we start at 100, and we need to know what the price is going to end up changing to. Okay, so the price is going to be the following. It's basically going to end up being the price times the change times the leverage factor. So it's going to end up being 100 times 1 plus 10%, and I'm going to hit enter for a second, right? And you can see that comes up to 110. But that's not the whole formula, right? The whole formula is that we're multiplying this change, and let me put parentheses around here, just I don't need to, but I want you to see it, times 3. But instead of putting 3, I'm going to end up putting this here. So I don't go up, okay, I did that backwards. All right, so I do 1 times. D5. And so it is the change. It's the change, which is really the D5, right, that I've done. And I'm triple leveraging this. So this should have been on the inside. Sorry about that, guys. Okay, so I'm going to take the C, right, and that's going to end up giving me the right number. So look at what I've done here. I've taken the number, that we were looking at where we were. We went up 10%. On the triple, you're going to build your formula so that you're looking at C7. C7 is yesterday's price, and we're going to multiply it by the change, which is 10%, and times 3 because that's the leverage factor. Okay, a couple of things. Here's the way you end up building out your formula. If you're not an Excel person, this just be, a quick aside. If you are, I'm sorry, I know it's going to end up being basic. I want to be able to copy this into the next cell. I can't copy it into the next cell because it's not going to end up working. It's not going to give me the formula that I want. And this is a whole thing about absolute versus relative addressing. And so let me come over here really quick, and what I'll do is I'll show you on the C7. Right, you see the C7, I'm always going to want to end up using the previous day. That makes sense. When I copy it over, it's going to end up being the same. The next one, D5. D5 is going to make sense, but if I copy it down here, I need to end up having the 5 stay constant. So I'm just going to keep hitting F4 until I get $D5. Now the 5 will end up staying constant when I copy it down to the next area. Next one, B8. B8 is going to end up being the leverage factor. So the leverage factor is going to have to end up staying constant. I'm going to have to change this when I end up copying it down. So I'm just going to leave it as a full time. Now when I end up copying everything down over here, and let's just make this $1. Look at that. It didn't work, right? Wouldn't you have thought that if you went from 10 to 11 back to 10, shouldn't the triple have gone from 10 or 100 to 130? And let's make this 10 also, just so that you can end up seeing we're comparing apples with apples. How come this number's less? It's less because of the leverage factor. When we went up by 30% because the dollar amount was $1 divided by 10. When we came down $1, since it was 1 divided by 11, not 10, we came down 9%. So when I triple leverage this, when I go up 10% times 3, I go up 30. But when I come down 9.9 times 3. So I'm coming down 23, like 0.2 or 0.3 times. And so we call this leverage leak. Some people call it bleed. But this is the factor that ends up showing what ends up happening as the market moves up and down. The whole issue, by the way, gets worse with 2 different factors. The first one is the leverage factor, okay? And if I take a look, and let's do this on a 5-time leverage. Copy, paste here. I know I'm going to have to end up changing this one. Okay, so you can do this a couple different ways, right? The way I do this a lot of times is I'll just drag things to I know where they need to go, right? So this leverage factor needs to be changed there, okay? And when I click on this one, the leverage factor needs to be changed there, right? So we knew that was going to end up being. Let's take a look at the 5-time leverage. We go up just the way you'd expect on a daily basis. We're going to get 5 times that 10%. So we go up, right? We go up here 5 times the 10. By the way, if I showed you the percentage, and let me show you the percentage here. Right? The percentage difference is going to basically be the change on the daily basis minus, I did that backwards, right? Hang on, let me hit enter in. Okay. So here's what ends up happening. In simple math, if we were going to go up 10% and down 10%. And I can make this 10%, by the way, right? But if I go up 10% and down 10%, when I go up 50%, right, $10 to $15 to 50%, when I come back down either the 45 or the 50%, this goes from 10 to 15, and if it was 50% on each of these, this would go down to 7.5. Over here, you can see that we're really not moving very much. By the way, what is 10% of $11? It would be us going down to $1.10. So if I make this $9.90, okay, you can see how all the numbers now work out. We're up 30%, down 30%. So if you take a look at this, right, and we're going to call this column over here, I'm going to call this leakage. And here's what I want you to see. So we go up 10%, down 10%. Over here, what our leakage is that we lost a dime, okay? And here's what the math is. We're going to take our starting price minus our ending price. So you can see that if you go up 10% and down 10% in the single, you go up 10% of $10 is $1. If you go down 10% of $11, that's $1.10, right? $1.10 minus $11 minus $1.10 brings us down to $9.90. And you can see here that they're the same. So we lost, or we leaked 10% by going up and down the same percentage, not the same dollar amount, the same percentage. Let's see what that leakage looks like if we have a triple. If we have a triple, our leakage went up almost a factor of 10 for a triple. How about for if there was such a thing as a 5 times leveraged? Look at how the leakage gets so much worse when you're using a leveraged ETF. You know, they don't have 5-time leveraged ones. And the reason why they don't have 5-time leveraged ones is that the lawsuits would be too big. As it is, the triples are kind of hard, but you know what? Some people will want these. If you're using them instead of futures to get into something and get out in the same day, that's fine. But this daily rebalancing, okay, and that's the factor right here. Every single day, the triple or the double, whatever one you use, it will end up going up 2 or 3 times as much as it goes up on a daily basis, and it'll go down 2 or 3 times, okay, if the market goes down 2 or 3 times. So the leverage factors work perfect every day. But this up and down movement, the greater the leverage factor, the more the leakage. Okay, I wanted you guys to see this in an example. I wanted to build it out. I wanted to show you how you can do this in an Excel spreadsheet. Right? I thought it was really important that you're able to end up walking away learning how to end up doing this. Okay. Any questions about the leverage ETFs? Are there any specific ones, okay, that you guys have questions about? But the doubles and the triples all kind of work the same way. Okay. Let's talk about, remember I told you there were 2 factors, okay, that ended up hurting these things. One was the greater leverage factor. The other one is the greater the daily movement compared to its longer term movement. So if we have something that, say, has a tremendous amount of noise up and down, up and down, up and down, compared to something that just moves very little each day, over here this is a 10% swing. Let's use numbers, I don't know, let's say something like the VIX, right? It's not uncommon for the VIX to end up going, right? The VIX to go from 10 to 13, okay, back to 10 again. Now take a look at the leakage, okay? If I keep this the same, over here I'd have to be a little bit different, right? What would it be at? Oh no, it's a 30%. Hang on, let me just do the math. Right. So if we went up 30%, we'd come down 30%. So that would be 390 that we would end up coming down. So I'd have to go to, okay. Let's take a look at the factor of the VIX, right? Because it's not uncommon for the VIX to swing, 3 points when we're this low. Maybe we go a little bit more. I could end up starting at a higher level, but I just wanted to really end up showing you a 30% move, a 30% back, which is, like I said, not hugely uncommon in the VIX. Look at the leakage here, okay? We lose 90 cents on $10, or if I do this as a percentage, okay, and let's do this as a percentage so that you can actually see the percent that you're losing. And the way you would end up doing this as a percentage is that you'd basically take our 90 cents and we would divide it by the start of our $10, and we'd make this a percentage. Okay, so we lose 9%. Okay, we give up 9%, okay, when we go up and we end up going down to the same percentage, okay? And so let's take a look. What's that number, okay, when you end up coming here, okay? Take a look at the triple. This is, if this was the VIX, right? If this was the VIX, this would be UVXY. By the way, we can't even do a quadruple. Because if you take a look here, if you go up 30%, right, the triple would go from 10 to 19. On this day, you're feeling absolutely great. But if it goes down 30%, right, down 30% times 3 is 90%. Do you see how devastating this could be? Those are the two factors, okay? I wanted to go through the math so that you understood it, but the two factors that have drag on leveraged ETFs, one, the higher the leverage, the more the potential daily roll drag. Number two, the greater the noise, the greater the ATRs are, the daily, the average true range, basically the movement from 10 to, right, it's a $3 movement and then back. The greater that movement up and down, okay, the greater the drag will be. So when you have something that has a tremendous amount of movement up and down, but really, reverts back to the mean, back to the same price, in the long run, okay, that has the worst possible type of drag on it when it comes to, and we're going to get into inverses in a second, because of what goes on here, okay? Does everybody understand? So now, when you understand how this math works, and we come over to here, and we take a look at this triple versus, let's do the following. Let's do another one of these things with the VIX ETFs. And on this one, let's compare, right, the VIX to, I'm going to compare it to two things, okay? I really need to end up putting in the VXX, right, because there's this whole roll yield, okay, and contango that we'd have to end up dealing with, okay, that ends up applying here. So the baseline is really not the VIX, it's going to be the VXX. And then let me end up coming over here and showing you its leveraged one. Again, here, let's get another comparison going. And let's take a look at the UVXY here. Okay. So what we're looking at is, let's look at our time frame. Okay. Let's take a look at, right, we have a 1 year time frame of the VIX is the candle chart. Because there is no VIX cash product to trade, if you wanted to end up actually buying the VIX, you'd have to end up using a VXX or one of the similar type products where they synthetically build the VIX on a daily basis using the VIX futures that we talked about. Because there is no VIX future, and we've covered this in a different video. I don't want to do this on this one. You'll go back and you can end up finding in the library. So they build a synthetic, right? They build a synthetic VIX using the VIX futures, and that's the VXX. But here's the 2 times leveraged. The VXX is down 83%. The UVXY is down even more. Now, you can say, well, it's a longer term. The challenge is that this, unless you get a unidirectional move, if you get a unidirectional move, all ups, no downs, or vice versa, the leverage will do incredible. You get any noise in a movement up, and you're dead. You're absolutely dead because of the math that we just went through. Let's take a look and see a shorter time frame. What happens in 6 months? Okay. In 6 months, you can end up seeing what ended up happening here is that, and this is, I have multiple things, so this is just going to be a percentage. The percentage is based off of the VIX. Okay, so that's where you'll see the percentages over here. But then every other line is based on its percentage, not on its price. So here's what I want you to end up seeing. As this starts to end up moving, when you have these huge moves up, when you have an enormous bar up like this, look at what happens to the triple. Now, if you don't remember, it's up here. Blue is the UVXY, magenta, or the pinkish color line, is the VXX. Yes, the VXX moves up along with the VIX, but not quite as much. And the UVXY really moves up. Same thing if you take a look at this section. But as soon as you come out of this and you end up having these, again, these big daily movements, only for things to end up coming back to their mean, okay, the VIX has some of the worst drag of any product or security out there because of its high daily movement and its high reversion to the mean characteristics over a long term. I know of no other security in the world, okay, or other type of, stock or ETF that you can end up buying that has greater daily movement in combination with greater reversion to the mean characteristics than the VIX. This creates, issues for the whole leverage, and you can end up seeing the leverage here, okay, become a problem. And so the leverage, the more you end up having something with leverage, okay, and this is what you need to walk away with. Number one, how much is it going to end up being having movement up and down, the daily movements of up and down? Because the more up and down that I have, okay, the worse my performance is going to end up being with a leverage factor. 2, the higher the leverage factor when that happens, the worse my performance is going to end up being. And so you need to end up realizing this. Now, if you have the UVXY and you happen to end up investing right down here at the bottom and you catch this unidirectional run, if you take, this is just going to be an absolute beautiful thing for your UVXY stuff. How often does it happen? Not a lot, right? Not a lot. It's really difficult to pick that timing. So just realize that you're turbocharging, okay, your results, and if you kind of hit the trifecta, okay, up, 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 up constantly, great product. Otherwise, you're going to end up struggling quite a bit, okay? Any questions? Because that was everything I wanted to end up going over on the leveraged ones. I want to go over the inverse also, because I think that's another important thing. And this, I'm going to end up getting now to the inverse. Let's use the one that's going to have the worst drag of any inverse product out there. And that worst drag, as we talked about, because of the characteristics, are going to be that of the UV, of the VIX-based products. So let's take a look at XIV, and I have that over here. I moved it. Okay, let's go back to our spreadsheet, and now let's do an inverse. Okay, so the inverse is going to be a single short. Okay, and we'll end up keeping all of this here. I'm just going to copy this. I'm going to have to change some things because it's not. And I'm going to have to end up making this a -1. And then just go through here real quick. Okay. So over here, I just need to end up pulling this down to here. This, I need to pull this down to there. Okay. And oh, that's what you're going to see. Okay, so let's talk about an inverse product now. Okay, one of the challenges, and let me bring this back over to here. This was okay. I still don't have my math right here. Let's take a look here. Oh, that's what I had to do. Sorry, I did that in the wrong order, so I'm going to have to do it again. Let me copy that, put that over here for a second. Okay. Took an extra second there, but that was supposed to be 10. Okay. Let's take a look at what ends up happening with the inverse. Okay. If the VIX goes, right, if the VIX goes from 10 to 11 back to 10. And let's say it's the VXX, right? So that's what I want to end up doing. And so we can end up looking at, this would actually be, because it doesn't price off of this. So if we were truly the inverse of the VXX, what ends up happening is that we go from 10 to 11 back to 10. Okay, here we would start the XIV at 10 also. When the VXX went up by 10%, we would lose 10%, right? You see, so they go from 10 to 11, and we go from 10 to 9, right? They go up 10%, we go down 10%. On a daily roll, that's exactly what ends up happening. The problem is with day 2. What happens on day 2? On day 2, they go from, let's say, $10, $11, they come back to 10. We already know that there's going to be leakage on the VXX, so this is going to end up being a little bit worse. But let's just do the example. Price of VXX goes from 10 to 11 back to 10. So we go up 10%, each of us, right? It goes up 10%. The VXX goes up 10%. The XIV goes down 10%. What ends up happening when we come back down to 10? We've already done the example. It's not a full 10%. It's 9.09%. But look at what happens here, and I can make this so that you'll see here. Right? So they go down 9.09%. We go up 9.09%. They go from 10 to 11 back to 10. We go from 10 to 9 to 982. We just lost 1.28%. Okay, on a 10% move. Now, how often does something like this happen on the VIX? The answer is really quite often, right? So this inverse factor you end up having, you have not only a leverage bleed when you're using an ETF, but when you're using an inverse ETF, it's not the same as shorting the index of the ETF. It works very, very differently. For those of you who are math guys, you realize what we're doing is that this really is very algorithmic. If you take a look at the way it ends up moving up versus the way it ends up going down, when we take a look at charts, okay, one of the things that you take a look at, you have a choice of using log scales. And using a log scale, all that ends up meaning is that it's going to end up saying that on your graph, if you started at 10, equidistant going up, let's say if we go from 10 to 20, that would be the same as going from 10 to 5, right? You either go up 100% or down 50%, because it's like if you double, you have to then half to get back to where you are. If you double, if you go from 10 to 20, you have to cut that in half to go from 20 back to 10. So that's what the logarithmic scale looks like. That's the issue with the inverses. All of this math had to end up playing into if you're going to do something like Vol Vantage, which I've worked a long, long time on, you have to end up realizing that the VXX has that big contango drag that we've talked about in previous videos, but this is the drag that the XIV has to live through. You then have to end up taking a look at both of those drags, and many, many times, unless you have a unidirectional move, those two factors will end up hurting each of the ETFs. Now, which one will hurt more compared to the contango roll? That's where it's difficult. In the Vol Vantage trade that I put on, we went long when the VIX was at 12. When I end up speaking to some people and said, I'm going long the XIV, I got the standard reaction from most of the professionals that I ended up dealing with, where they, like, what kind of idiot ends up, buying, the VIX when it's at 12? And I laughed and I said, this type of idiot did. And it's like, what's the matter? Oh, by the way, my friends from Brooklyn, they were a little bit different. There were a lot more expletives, before the word idiot, And so, how could you possibly do that? And it's because you have to understand what drives those products are three factors. Obviously, a huge direction or a unidirectional move has the biggest effect. By far, no question about it. Having the VIX, go from 12 to 20 would really end up hurting that trade. Now, before that ends up happening, before it goes from 12 to 20 in the blink of an eye, the futures have to change. And they'll change in their relationship between the first and the second and the third. Right? All of those lines that I've drawn, each line ends up changing when you take a look at the VIX futures. And the VIX futures are the things that always move first. That being aside for a second, the next two factors are how much does this contango drag hurt versus how much does this inverse ETF factor hurt. And now it becomes a math game to end up seeing which one will have a greater effect on the price of the long ETF, VXX, versus the short or inverse ETF, XIV. And because of these two factors, okay, that's where I started to end up trading the Volvantage trade because of I was trying to take advantage of all of these things. Now the problem is you take all of these factors and you then put them onto a chart like the XIV and or the VXX here, and you end up this is just pure the contango, okay, the contango backwardation drag. You can see over this period of time, right? This period of time, 6 months, there was almost a 50% drag on the VXX. That's why when I ended up showing you this other graph over here, what you're looking at here is that, and let's go over the same 6 months because we're not in 6 month time frame here. We're in 1 month because you got to look at different time frames. Right? We'll go 3 months daily. Here, what you're looking at again, the VIX is the bar chart or candle. The blue line, you can see that over here, is the VXX. The pink line is XIV. And so you get this contango drag. And so over the last 6 months, you can see how there was a lot of noise going back and forth. Which one should you be long? Okay. We went long on, I went long on the 22nd. Okay. At this point, when the VIX was, 12, what ended up happening is that the VIX futures and the way they structured, the way we did our proprietary indicator, ended up saying that the contango drag right now will be greater than what I would lose with the inverse drag. That is a statement about XIV, the inverse ETF, right? The inverse ETF has that inverse drag that we talked about, that we went through, in the Excel spreadsheet. The inverse drag hurts when there is a lot of volatility up and down, like over here, right? Up and down, over here, up and down. When you have those bigger moves, what ends up happening is that your inverse drag is much greater. Therefore, what ended up happening with the pink or the magenta line, the XIV, the gain that we were getting when we were dealing with our contango was being outweighed, quite frankly, by the movement up and down and hurt the inverse drag of the XIV. Once things started to smooth out a little bit, and we got through our known events, meaning the election, and we were at lows and things didn't end up appearing that they were going to be moving, all over. And the math, looking at all of the VIX futures about the contango, at that point, we had a high probability that the contango drag on the VXX was going to, and the contango drag, right? The contango help that we, let me put it this way, because we went long the XIV. The contango help that we were going to get on the XIV was outweighing the inverse drag. And so therefore, that's why, I went long the XIV. The same thing happens, by the way, during, horrific situations where we have these huge market sell-offs, where if we ever go into backwardation on those VIX futures that we talked about, then it's reversed, right? Then the XIV has the backwardation drag, and the VXX has the backwardation, wind at its back. It'll end up helping it to perform. So I will leave you with this. Okay. Three separate points. Number one, understand how leverage ETFs affect you. Okay. The leverage, the more the leverage, okay, the greater the leverage drag when you have movement up and down. Inverse drag. You also get inverse drag, but on inverse drag, what hurts you much more is the bigger swings. When you have the bigger swings up and down, that will end up hurting in inverse compared to the -1 versus the +1, right? The inverse versus the single long. There's huge drag on both of those. Okay, before you use any ETFs, okay, understand how your ETFs will end up being affected. The reason why I wanted to start using the XLF, the financials and the triple financials, was because I thought that made a lot of sense. That's the way most ETFs work. Because they're the underlying, they don't have this other layer of complexity. I had several questions, okay, that came to me about XIV, about how that would end up working, and because the VIX is a kind of unique product, it's unique in the sense that it's the only futures, right? It's the only future product where you can trade the spot or the cash price against it. And so there's a whole bunch of other complexities in there that, beyond, okay, this hour. But I did want to end up showing you, okay, those two factors because it is a trade that, I do put on, and I know people end up asking questions about it. Any other questions about inverses or leveraged ETFs? If you use them with caution. Use them when you're going to be trading in a day. They're a little bit tougher product to end up using if you're going to plan on holding them for any duration of time. If you do hold them, I'd hold them on products that didn't end up having this huge daily movement up and down and didn't end up having as high a reversion to the mean characteristics as the VIX. Anyway, I hope this was useful. It's what I consider to be, the fundamentals or the basics, okay, that anybody who's going to be using these products really needs to understand. So anyway, have a good day, guys. I'll speak to you soon.